And it's time now to present another Blue Chip Book Award. It goes to A Random Walk Down Wall Street by Burt Malkiel. The book has long been established as a must-read among when you're first starting a portfolio. It is one of the great classics on investing, and Burt Malkiel joins us now. It's great to see you this morning.
Thank you.
This was one of those books that explained to people that maybe stock picking was not such a brilliant idea.
I think the way that I put it in the first edition was that a blindfolded chimpanzee throwing darts at the stock pages. Of course, they don't have the stock pages in the papers anymore, but at that point they did. That chimpanzee could pick a portfolio that would do as well as the experts.
So the world's actually moved in your direction.
Slowly, but now it has. I would say about 26% of mutual fund assets are now indexed.
And if you could write the book again, 30 years later, what are we, 30 years later? Almost more.
Almost 40 years
Almost
later.
40 years later. What would you do differently? Would you do anything differently?
Well, first of all, I wouldn't do anything differently about its basic message. The beauty of the thing is that it works. I mean, last year, over 80% of active managers were outperformed by the index. Normally, it's about 2/3, but the 1/3 that win one year aren't the same as the ones that win in the next year. So I wouldn't have changed one sentence of that. What has changed is that there weren't any index funds when I first wrote the book. And in fact, it was reviewed at one point by a market professional in Business Week who said, this is the biggest piece of garbage in the world. Now, the world has moved in the direction of Random Walk. And now, not only do you have index mutual funds, but you have an ETF revolution. And these are basically index funds. So what's changed, and one of the reasons that I keep redoing, make updates to the book.
You're into the 10th edition now of the book?
That's in the 10th edition is now you can put a portfolio of ETFs together, almost zero expense, and any investor, including the individual investor, isn't going to have a mediocre performance. It's going to be an above-average performance.
And yet we have so many individual investors who are afraid of the markets today based on what they had seen just over the last 4 years and the fallout from 2008. Does that worry you that there's a generation of people who aren't going to be investing in markets?
It worries me a lot. It's one of the things that I preach in the book, that unfortunately the individual investor does just the wrong thing. Individual investors put more money into the market at the top of the market in the early months of 2000, during the dot-com bubble, than ever before. They then took the money out when the market had a low in 2002. And then in 2008, when the world was falling apart, that's when the money all went out. And this is one of the main lessons in the book. My God, you'll never time the market. I've never known anyone who could consistently time the market. When you do it, you're likely to get it wrong rather than get it right. Just go into your 401k, keep putting the money in. When everyone says the sky is falling, don't listen to them. Just keep going.
And do you stick? I mean, you just mentioned ETFs and trying to put a portfolio together. I'm curious, is that a better alternative than just picking an index and saying, I'm doing that?
Well, I think if you did one thing, if you were just going to buy one ETF, I would buy a world equity ETF. That ought to be the core portfolio. There may be some changes you want to make around the edges. And incidentally, I don't mind if you buy individual stocks, but do it if the core of your portfolio is indexed, and then you can buy individual stocks with a lot less risk than if your whole portfolio was done that way.
I noticed you said that real estate is where you think is the best investment now. And if you do you think REITs are appropriate?
I think REITs are appropriate, and if you wanted to have a position in real estate, first of all, you'd get it with a broad-based index fund because there are some REITs in it. If you wanted to overweight REITs, buy a REIT index fund because the REIT index funds do very, very well. And if, in fact, we're going to be in an inflationary environment over the next decade, REITs would be a very good place to be.
Have you seen the actual award that they're giving you here?
I have not.
It's a little wooden plaque.
Wonderful.
Don't you think CNBC could give you something like a golden book or a crystal ball or something?
I have the award, actually.
Oh, you
I
have
was
the
going to
award.
present
You're the
the
keeper of the
award
award?
to him.
Well, the box is nice.
It is a nice box. I wasn't going to open this because we have another award, but we should. Maybe we should open it for you. My other question for you, bonds, right now. How do you think about the bond market? What should average Joes be doing?
Okay, and I am very worried about the bond market. That's one of the things that has changed. We're in an age of financial repression, and I think people should remember a bit of history. We pegged interest rates after World War II at it couldn't be higher. Government rates couldn't be higher than 2.5%. We kept the peg on into the 50s. The peg was just gradually removed, and bond investors suffered enormously in the whole period from World War II until 1980. Now, the government did well. The debt to GDP ratio in the U.S. was 130% in 1945. It was 30% in 1980. And that's what worries me. With the paralysis in Washington, with our inability to do anything about the, anything real about the deficit, we're going to solve the problem, but on the backs of the bondholders. Right. And I say, don't buy bonds.
We pegged rates at 2% this time.
Now it's 2%. Right. It's even worse.
But it goes to 2014, not for 30 years.
Yeah.
Burton, congratulations. Here's your award.
Oh, I thank you very much. That's
you are
lovely.
now an official member of the book club. We'd love you to sign the book if you could.
I'd be happy to.
We have a pen over there, Judd. Thank you, sir.
Someone who will not be getting that award is Judd Gregg if he doesn't like it. You know what I mean? I just can't,
Judd, thanks so much. Oh, not Judd. You're not. Burton, thanks so much.
You will never get one. Doesn't matter what kind of
on the book. We got to have you back. I want to hear what you think of gold at some point. I imagine you have
not getting
your own views on that.
You're not getting one.